these new laws? What tax planning strategies are even applicable under these new tax provisions? To answer some of these questions, the MBA ICLE, in partnership with Simmons Cooper Partners, have commenced a tax series to address core areas in the new tax provisions. And the series begins this afternoon with this training titled Decoding the New Law, with a narrowed focus on annual income tax returns and stamp duties compliance. My name is Oluwadolapo Owoyokun. I'm a tax associate at Simmons Cooper Partners, and it gives me great pleasure to moderate this conversation in this training. So I welcome you all once again. Before we begin, here are some housekeeping rules, please. This training is divided into 3 core sessions. The first training is on navigating annual income tax returns compliance under the 2025 tax frameworks with our facilitator, Mr. Samuel Oyenitun, FCTI, followed by the second training session on an overview of stamp duties in Nigeria under the new tax regime by our facilitator, Mr. Bashir Ramoni, FCTI. Additionally, please note the third session after the second session is the Q&A session where our facilitators get to address questions from our participants. Additionally, please note that while the training sessions are ongoing, you can drop your questions in the Q&A box. And if you are joining us live on YouTube, you can also drop your questions in the comment section and we'll get to it in the Q&A session. Please also note that this training is an MBA ICLE accredited course. Therefore, it means by participating, you get to claim 1 CPD point when you fill the form on the link that will be dropped in the chat box in due time. Having said this, may I also welcome you all once again to this training session that promises to dispense so much value to you. And I can confidently say this because of our facilitators who are experts in the field with seasoned and long experience in both public and private practice of tax law in Nigeria. May I also usher us into the first training session without further ado by reading the citation of our first facilitator. Mr. Samuel Oyenitun, FCTI, is a legal practitioner, notary public, and managing senior associate at Simmons Cooper Partners with over 18 years experience in general legal practice, including taxation, dissolution, criminal prosecution, and dispute resolution, with 15 years of such legal practice specializing in taxation. He is a fellow of the Chartered Institute of Taxation of Nigeria, CITN, and is widely recognized for his expertise in personal income tax and tax compliance. Called to the Nigerian Bar in 2008, Mr. Oyenitun previously served at the Lagos State Internal Revenue Service as head of the Criminal Prosecution Unit, where he led tax prosecutions, dispute resolution initiatives, and revenue recovery efforts. He also played an active role in capacity building and professional development programs. Mr. Oyenitun is a published writer on taxation and public finance and a regular facilitator at professional trainings, including capacity development programs organized by CITN, State Internal Revenue Services, and private sector organizations. He holds an LLB from the University of Ilorin, BL from Nigerian Law School, Lagos, and an LLM from University of Lagos, and maintains professional interest in tax administration, anti-tax evasion advocacy, and property law. Ladies and gentlemen, before I welcome our facilitator, may I advise us to pay keen attention to this session because the knowledge and insights that will be dispensed are byproducts of over a decade experience as the former head of the Criminal Prosecution Unit at the LRS. This is the unit in charge of prosecuting those who fall short of their tax compliance obligations. That is, even annual income tax returns compliance. Having said that, please join me to welcome Mr. Samuel Oyenitun, FCTI. Thank you. That was slow. That thing was slow.
Good afternoon, learning 6, learning seniors, and colleagues. And you are welcome to this MBA webinar. I'll be taking the first session. Please permit me to share my slide.
Okay.
Kindly confirm if you can see my slide. Okay, so very quickly we'll be dealing with the topic navigating annual tax return compliance in Nigeria, the 2025 framework. And just before we delve deep into this, let's look at our webinar outline. Okay, so on the outline, we have the introduction, and secondly, we have the constitutionality of the filing of annual tax returns. Then we look at the pre-2025 filing of annual tax return obligations as is under the old law, which has just been repealed. Then we look at the post-2025, that is the legal framework under the new tax regime. We will consider the overview of annual tax return compliance. We will consider filing of annual tax returns for individuals, for companies, and then we look at the procedure for filing, then the penalties for non-compliance, then we conclude. So let's begin. As we all know, on the 26th of June, 2025, the president passed into law new tax laws, and this repealed the old laws. So it marked a significant milestone in Nigeria's tax history. And these 4 tax laws that were passed includes the Nigerian Tax Act, the Nigerian Tax Administration Act, the Nigeria Revenue Service Establishment Act, and the Joint Revenue Board of Nigeria Establishment Act, all of 2025. Now, these laws are significant for so many reasons, but let's look at the 2 first sections of this law. Going by the provisions of both Section 1 and 2 of the Nigerian Tax Act and the Nigerian Tax Administration Act, respectively, it all talks about the objective of this law and then the application of this law. Now, talking about the objective is to consolidate the multiple tax laws we have in Nigeria into few or a single law. Unfortunately, the team, the committee, the fiscal policy team were unable to consolidate all these laws into a single law. However, they've been able to consolidate this into 4 laws. And secondly, looking at the provisions of the Section 2 of both laws, it talks about the applicability of this law and that it applies generally to all taxable persons. As we proceed, we will see who a taxable person is as defined by the law. So first and foremost, let's look at the constitutionality of filing tax returns in Nigeria. For any law to be valid, inclusive of the tax law, it must derive its power from an enabling status. What is the enabling status for tax laws in Nigeria? And that is the 1999 Constitution of Nigeria, so which is the ground norm for all laws in Nigeria. Section 24, paragraph F of the 1999 Constitution specifically provides that it shall be the duty of every citizen of Nigeria to declare their income honestly and pay their taxes promptly. The word declaring income honestly is the same thing as tax returns. Tax return is simply declaring the income that you have earned in the course of that year and all other transactions that occurred in the course of that year, and then pay your taxes promptly. So every other law that will follow, including the new tax legislations, derive their power to mandate citizens of Nigeria or taxable persons generally to file their tax law from this law. So let's look at what obtains under the old law, which has just been repealed and as at 31st of December 2025. Now, we start with the employer's tax returns. By virtue of the provisions of Personal Income Tax Act, Section 81, subsection 2, it mandates every employer of labor to file tax returns of all emoluments paid to his employee in the course of that year, on or before the 31st of that relevant year. And the penalty for non-compliance of this is provided in the same Section 81, subsection 3, which provides for a criminal penalty. As a former head of criminal prosecution in the LIRS. I have been involved in prosecution of so many taxpayers, including senior advocates, including lawyers, including stakeholders generally, including accountants and top government officials who have failed to file their tax returns. And some of them felt, since my employer has done this for me, or since I have paid, or since I'm paying regularly, I don't have to file. And so when we charge you to court, some of them will say it's just a penalty, because the penalty attached to it for companies is just a penalty of 500,000 naira. While for individual, inclusive of business names or corporate entities, is 50,000 naira. And some felt, because it's just a token amount, it's just a pecuniary. I've had cause to argue before the court that the reward upon conviction implies that it is a criminal liability. I've argued before so many courts who have been reluctant to grant this, to say that the law is the law. And in tax law, once the language is simple, you should apply the literal rule. And so in so many cases, even when you think you have done everything, you want to go under any law to object or to file a motion to counter it. The provision of the Constitution is very sacrosanct. And that is the fact that you must declare your income. So the first question that comes to mind, you might have paid anything. How are we sure that you pay the accurate amount you are supposed to pay? And that is where the issue of filing appropriately comes in. And so we also have an equivalent provision under, that's for employers we just mentioned under Section 81, sub 2 and 3 of the Personal Income Tax Act. On the Company Income Tax Act, we also have the provisions of Section 55, which mandates all companies to file their tax returns on or before the 30th of June, though that's not stipulated in the law, but as prescribed by the FIRS back then, which is the Federal Inland Revenue Service. And so all companies must file. This is the main returns. There are other sorts of types of returns that we'll also look at here, which were provided in the old laws that must be filed, including that of the capital market, by companies. But the main one is the company's income returns, which must be filed, like I mentioned earlier, on or before the 30th of June of every relevant year. We also have the obligation of individual, self-employed now. You know, we have individual employees. We also have self-employed individuals who are also mandated to file their tax returns under the provisions of Section 41 of the Personal Income Tax Act. One of the subsections, I think subsection 2 or 3, precisely provides that these returns must be filed on or before the 31st of March of every relevant year. Now, what challenges does this pose? Because this has not been tested in court, some tax authorities have opined that it means that including employees, and as employees of company, notwithstanding that their employer had filed, must also file. One of the examples is LIRS. LIRS is of this view that an individual employee must also file as the same way the self-employed will file. Some other tax authorities will just agree that once the employer has filed, they are filed. I'm sure they are one of those who pushed for this reform, this particular provision under the new Tax Act. So while some have said, once your employer has filed, you can jettison the mandatory obligation on the employee to also file by itself. So we will see what the new provision provides very shortly. So the post 2025 framework for filing of annual tax returns. So it now makes it mandatory that all taxable persons are required to file their annual tax returns. Now, these are some of the things we must note here. So whether or not the tax authority, this has always been in all the previous provisions, that whether or not the tax authority writes you, you must file. That's number one. Number two is that whether or not you are liable to pay tax. You might say, I didn't earn income. Payment of taxes is based on earning of income. But whether you earn or not, the law has now mandated it that you must file. Whether it is a nil or negative return, you must still file. So whether you are also granted exemption by the law or not, you must also file. So let's look at some few key definitions as provided in one of the new tax laws. And very quickly, we'll be considering the Nigerian Tax Administration Act. Section 147, as was in the old law, under Section 108 of Personal Income Tax Act, which is the interpretation section. Section 147 of the Nigerian Tax Administration Act, which will be subsequently referred to as the NTAA, is the interpretation or definition section. And it defines a tax return. The old law did not define what tax return is, but attempted to itemize some of the key contents. However, this new law makes a clear definition of what tax return is, and simply says it's a form or document that is filed with the tax authority, reporting transactions, income, expenses, and other prescribed information. Now, this, I need to dwell a little on it. Now, it said it involves transactions, income, expenses, and other prescribed information that the tax authority may also prescribe. I've been in court so many times while I was with LIS, filing charges against information at the High Court and some at the Magistrate Court for failure to file returns. And some lawyers who have come to defend them will even ask, what is even this tax return? What does it mean? Even some accountants do not know this. Even some taxpayers do not know this. So this will be a plus for us as lawyers, as tax consultants, and also as taxable persons to understand these keywords, know what it requires of us, and know how to appropriately apply this. And that will be a very good source of income for us as lawyers. So we have said it is a document. So what should be contained in that document varies. So if you are dealing with an individual, it differs from what obtains for an employer of labor. And if you are a company, if a company is filing annual tax returns, you will see some of the things that you will be required to provide as part of the returns. So who is required to file these tax returns? The law said taxable persons, but let's attempt. This law has done well, although Section 108 of Peter also provides for the definition of both a person and taxable person. But the new tax administration act has given a broader definition of what this means. Let's look at who a person is. It defines a person to include individuals, body of individuals, executors, trustees, families, communities, companies, corporations, so that's a business enterprise, and unincorporated bodies, including trusts or legal arrangements. So if you fall into any of these categories, it means you are a person as recognized by this act. Whether you are a family, whether you are an individual, whether you are a company, whether you are a community, one way or the other, you are a taxable person. So you are liable to file returns. So what is the definition of taxable person as defined by this act under Nigerian Tax Administration Act Section 147 as well? It defines a taxable person as a person. We have defined who a person is, those categories of people who carry out economic activities in Nigeria or exploiting tangible or intangible property to generate income through trade, business, or government agency activities. So you might be doing one activity or the other, whether tangible or intangible. Some of you might say, what is tangible and intangible property? It could be shares. It could be passive income, rent you receive from your company. It could be dividends. It could be interest. It could also be sale of property where capital gains tax will apply. Any other thing you do, either as a law firm, as a business entity, whatever kind of transactions you do that involves economic activity with the purpose of generating income or making profit, then this law applies to you. That's what Section 2 of the Nigerian Tax Act and the Nigerian Tax Administration Act provide. And then this section also says that the people liable to file are taxable persons. So if you do any of these things for the purpose of generating income, you are liable to file. So why do you file returns? Number one is for tax compliance purposes. So if you comply with the law, what is compliance? Compliance is you just agreeing or conforming to the established rules or laws. So the moment you comply, you'll be in the good books of the relevant tax authority, and it will be on record that this company, this person, this individual is always complying with the tax laws. Number two is to avoid the best of judgment assessment. Under the old law, Section 54, subsection 3 of the Personal Income Tax Act, which also has an equivalent version provision under Company Income Tax Act, provides that if you fail to file your tax return, the tax authority is at liberty to assess you to its best of judgment assessment. And that's another one for that is an estimated income. So they have different parameters for doing this. It could be your lifestyle, your status in the society, the environment you live, the kind of cars you ride, and so many other things. However, the caveat pictorial authorities have put is that it must not be arbitrary. So whether it is arbitrary or not is for the court to decide, and then also for you to also determine and say, okay, this is arbitrary or not. But don't wait until you get into that shoes, because a lot of things will have to be disclosed, and that includes you disclosing your bank account, because if they have assessed you to a sum that is far higher than you are expected to, then you have to, and you are objecting to such assessment, you may have to defend it by providing your bank statement and some other things, and you must be able to explain in details what is contained therein. So Section 35 of the Nigerian Tax Administration Act also makes a similar provision. It has now changed the nomenclature from best of judgment to what we call the administrative assessment. And so another reason why you must file your tax returns is that it facilitates correct or proper assessment by the tax authority. It helps the tax authority to properly assess you to tax. So when you file, the law says that they must be guided by what you have filed, except they have reasons to believe that you have not filed the correct amount of taxes. Then further questions can be called. So another important point why you should file your tax returns, whether as individual taxable persons, consultants, or even lawyers, as stakeholders, as custodians of the law, we must comply with this, is that number 4, it gives you some statutory benefits, and one of it is having access to be able to obtain your tax clearance certificates. One of the conditions for you to be able to obtain your tax clearance certificate is that you must be filing your tax returns adequately and promptly, at least for a minimum of 3 years before you can apply for that tax returns. On the final note, which I will add to it, it's not included in the slide, is that another reason is that for the tax authority to be able to ascertain whether what you are paying is actually accurate or not. Sometimes you might decide to pay anything, but if you file your tax returns, they will look at it and compare, oh, this person is actually saying the truth. And if they have any reasons to doubt, you might be required to furnish further details. So very briefly, we look at the overview of tax returns. Don't forget the other time under the new tax regime. Don't forget the other time that I said there are different kinds of returns that you must file. Now, the first and the two most important ones are the returns by individual employees and self-employed, and another one by employers, and the last one is by companies. Those are the major ones. But there are different kinds of taxes, which briefly I will mention here. They are contained in the Nigerian Tax Administration Act. Section 1 of that law, of that Section 11, provides for the provisions for filing of annual tax returns for companies under Section 11 of the Nigerian Tax Administration Act. Section 12 provides for estimated income for companies, filing of returns for companies under the liquefied natural gas. That is, if you are engaged in such kind of business operations, you are required to file estimated returns. And then Section 13, sub 1 and 2, subsection 1A and B, provides for self-employed individuals and non-residents to file their tax returns. Section 14, sub 1, now makes provision for employers of labor. That's an equivalent provision. This was exempt 1 sub 2 of the Personal Income Tax Act. So Section 14 sub 1 of Nigerian Tax Administration has similar provision that you must also comply with. And subsection 3 now mandates every employer, every employee, notwithstanding that your employer filed, to also file. So we have some other ones. We have section 16, which provides for returns for upstream petroleum operations to file estimated returns, and section 17, they are to file the actual returns as opposed to the estimated returns. We have in section 22 returns for VAT. You must file your returns for VAT. We also have under section 26 and section 25 for virtual asset provider service providers. You also have obligation to file your returns. Section 26, companies that are granted priority by the government must also file. Section 27, for those who are also granted tax incentives, they are meant to file. Section 28, for all withholding taxes that were deducted at source, you are meant to file. And then section 29 of the same act mandates financial institutions, banks, stockbroking firms, insurance companies to also file returns. In the past, the law only says you should compute the name and the address of new and existing taxpayers. It even contains just the new taxpayers. But in the new law, it now says you should compile both the name, the address, and transactions. Now there's a threshold. Some of the conflicted gazettes, one has 25 million threshold for individuals. Now it has been increased to 50 million naira transactions. So if you have transaction ranging to a sum of about 50 million naira in a month, the bank will report this. The conflicted gazettes, the previous one said monthly, another one said quarterly. But now in the recent gazetted copy, which was on the 4th of January this year, 2026, it didn't provide for the period. That means they must be doing this. And that for me is not a good provision, because the bankers and whatsoever you have, financial institutions, may not know when this should be done. So let's look at this holistically. We'll start with the employer's obligation. Like I mentioned earlier, section 14, subsection 1 is a replica of what obtains under section 81 sub 2 of Peter. And it says that every employer of labor must file tax returns of all emoluments, everything you are paying to your employees, leave bonus, allowance, any other bonuses, or any other thing you pay, you must file, you must do a schedule of this, which comprises of the transaction, the expenses, any other thing that you feel is necessary. And that will include some other things like your name, your pay ID or tax identification number, your nationality, your address, email address, and all other information, designation, and so on, as may also be prescribed by the tax authority. And the deadline for doing this is on or before the 31st of January of every year. So for this year, every employer of labor, as long as you employ staff in your organization on or before the 31st of January this year, you must file. And it's no longer an excuse, whether they earn income or not, whether it is nil or not, you must file your tax returns. What about the employee? Under the old law, like we mentioned, there were challenges. Some tax authorities opined that it is also necessary for the employees to also file, notwithstanding that the employer has filed. So section 14, subsection 3 of the NTA has now specifically provided that notwithstanding that the employer has filed, you must also file your tax returns. And this must be disclosed from all sources of income, because the only source that will be available to your employer is just your payee or your salary income. So if there are other incomes, you do business by the side, you buy and sell, you trade, you do some other things, you even earn passive income like rent, you must disclose this yourself. However, the law failed to provide the timeline. The old law says on or before the 31st of March for every individual. And if you look at this provision, it refers to section 13, which is for self-employed. It mentions specifically that this subsection 3 must also be in accordance with section 13(1), which is for self-employed. However, the timeline or the deadline for doing this It's not stipulated. So that makes the law not good enough, and some adjustments or amendments may need to be done to this. Okay, so for companies now, as provided under the old law, which is Section 55 of CITA, Company Income Tax Act, Section 11 of this Act specifically provides that all companies must file their tax returns. And in doing this, there are different, there is a stipulated period. Like I mentioned earlier, under the old law, you must file this on or before 30th of June of every relevant year. And that is done on Tax Promax. So very briefly, I'll mention the context, but before I get there, what is the stipulated period as stipulated in that act? So for a company that has been in existence for at least a period of up to 18 months, it must be filed not more than 6 months after the end of the calendar year. And for a newly incorporated company, within 18 months of incorporation of that company, or not more than 6 months after the end of the first calendar year, such company must file, whichever is earlier out of the two, they must file their tax return. What are some of the contents? Like I said, this is more complex and will require the service of experts like accountants to help you, because one of the key things, apart from your self-assessment form, you require an audited financial statement. I doubt if a management account will be accepted. If you are filing on tax promax, which I've always done regularly, if you don't have your AFS, you might not be able to successfully do this. In the past, the penalty is 50,000 naira for the first month, and subsequent months will be 25,000 naira. So if you fail to do it on or before that 30th of June of that year, you will be required. So you need to get your books in order, and your AFS, which is the audited financial statement, must be ready. Evidence of payment of tax due, VAT returns, and evidence of payment of the VAT, all this must be disclosed. And then your computation of effective tax rate, which is now pegged at a minimum of 15%. Then attestation by a principal officer of the accuracy of the information. Whosoever the auditor is that prepared that audited report must certify that provisions both in CAC and under the tax law that the information that is provided there is to the best of his or her ability. So I've mentioned the duration when this can be filed. Now, for small companies, the law exempts them from filing Section 22 that's for VAT returns generally. Section 22 of the NTA deals with VAT returns, but it exempts small companies or small businesses from filing VAT returns. And the law has defined small businesses to mean a company with a gross turnover of 100,000 or less than 100,000, and with the fixed assets of not more than 250 million naira. 100 million or fixed assets not more than 250 million. So they may, however, waive this exemption not to file. They may decide not to file. They are not under obligation to file. But if they want to file, subsection 5 of that section 2 says they must put it in writing to the appropriate tax authority, which is the Nigerian Revenue Service in this case, that we also want to file. So, and there are ways of determining whether you are liable to file or not. What is the simple procedure for filing this? Number one is that Section 4 of the Nigerian Tax Administration Act simply provides for the procedure. And the first thing is that you must register with the tax authority. If you don't have a tax identification number or a payer ID, you may not be able to log in and file your tax return. So it is the duty of every taxable person to register. There are penalties for failure to register with the tax authority. There are even penalties for any company, for any person, taxable person, to be dealing with a company who is not registered with the relevant tax authority. So when you prepare this return, you log into the website of the various state internal revenue service or the tax promax of the NRS. And then when you do this, you go online. For instance, let me cite the example of LIRS. Their website is etax.lirs.net. And when you log in with your pay ID and a password which will be generated and personal to you, you go to the left-hand column, you will see where you can click. If it's for the employer of labor, you click on corporate returns. And if it's for individual, you see where you can click for your returns. You find whether you are an employee or self-employed. And so for companies, if you are filing on Tax Promos, you go to Tax Promos website. I think it still has FIRS there. I don't know if they will change it to NRS as time goes on. So, but when you get to the site, you log in with your details, and then you also do the same thing, but you have to upload your annual financial statement, which must have been prepared. For the state internal revenue side, whether Ogun State, you can also go to the Ogun State portal, Ekiti, any of the states, go to their state portals, they have it on the website. Just log in with your tax identification number and a password. Then when you log in, you will see a column where you can file your annual tax returns. Some will also request that you file your projections, what you think you will be paying for the subsequent year, what you think your annual tax will be. You file it alongside. You also have a schedule there for withholding taxes and for other schedules of payment which you have made. You can upload all this when you fill them. There are templates on each of these websites. You can download them and you fill it accordingly. So you must also fill in the accurate information. You must be sure, so that, because whatever you put will automatically synchronize, deduct the deductibles, and then bring the rest as taxable income. So it must align with what you have filed. What you have paid must also align. Otherwise, you might be called for questioning. And here, this is where employees must also be careful. So if you file something that is different from what you are supposed to file, and the tax authority summons you, if you know the only income you earn is your employment income, you must align with your employer so that you don't file what is at variance. In US, this is the practice. If you file something different from what your employer has filed, they will call for questioning. You might be invited for a desktop audit exercise. So then you pay the amount tax of tax due. So online, if you are filing online, you see the necessity for your rent. Now it's been capped at 20% of your rental income, rental payment. And so in actual fact, we have then when you have done these payments, there is a column where you must confirm that you must submit your tax return. Don't just say I've done it and I'll sleep there. You must submit as quick as possible and confirm submission as well. So what are the penalties for non-compliance? Section 101 of the NTA provides that if you fail to file within the stipulated time, it used to be a criminal liability under the old law, and now under this new law, it is now an administrative penalty of 100,000 in the first month of default and 50,000 for subsequent months. So if you don't do this within the right time, you'll be penalized. That's a cut across whether you are an individual employer or a company. So we have all other penalties, like those who fail to comply with virtual asset service providers returns. I've mentioned those who I highlighted them. Time will fail us to discuss all that. The penalty for that is 10 million in the first month, and for subsequent months is 1 million naira. And the license of such companies might also be withdrawn. So for those who are to file estimated or actual returns too, under section 128 of the NTA, we'll say there are 10 million naira in the first day of default and 2 million naira for each subsequent day of default. Those are for people engaged in petroleum operations. And then interest can also apply. In conclusion, the Nigerian Tax Administration Act introduces clear and more streamlined framework for filing tax returns by employers, employees, and companies respectively. By aligning with global best practice, the Act ensures that tax compliance is comprehensive, transparent, and equitable. Companies must ensure that they file their tax returns promptly, while employees are now required to also file their own returns, even if their employer has already submitted on their behalf, enhancing accountability. Administrative penalties also apply across, no longer criminal penalties. The ongoing challenges may include capturing income from sources beyond employment and how the tax authority will be able to decipher whether that is the only source of income or others. Overall, they have laid the foundation for a more efficient and effective tax system, but its success will depend on continued enforcement, taxpayer education, and system improvement. Thank you.
Wow. Thank you very much, Mr. Samuel Oyeniton. That was value-packed. So many takeaways. I have mine as well, and I'm willing to share too. The law is saying now that whether you are earning money or not, you have the obligation to file your annual income tax returns. There is no excuse of, oh, this year was quite tough, I didn't earn any money. In fact, I made a loss. You have an obligation to file your annual income tax returns, whether as learned colleagues or even as taxable persons, wherever we are, you have the obligation to file your annual income tax returns. I also learned that there is no age exemption to filing annual income tax returns. So far as you are doing economic activity in Nigeria through trade, whether you are 16 or 15 or 18, the law says you must file your annual income tax returns. I know we have some questions, and let me remind us once again to drop them in the Q&A box, and we'll address them in the Q&A session. Having said that, who is excited about the second session? And allow me please to usher us into this second session by reading the citation of our facilitator, Mr. Bashir Ramon, FCTI. Mr. Bashir is a partner at Simmons Cooper Partners. He's a seasoned legal practitioner, notary public, a licensed tax practitioner in Nigeria, and chartered arbitrator. His expertise in taxation, commercial and civil litigation, special tribunals, public finance, and alternative dispute resolution, ADR, reflects his versatility and capability to provide innovative legal solutions in various fields. In his current role, Bashir, as a partner, he leads the revenue law and tax advisory services, commercial and civil litigation, special tribunal, and alternative dispute resolution practice areas. He earned his bachelor's degree from the University of Ilorin, Kwara State in 2004 and was admitted to the Nigerian bar in 2006. He holds a Master of Law degree from the University of Ibadan in 2010, certificate course in international taxation at Shelton's International Tax Training Institute, SITTI, London, UK in 2019. He is a key member of the firm's management committee. He has facilitated many trainings and capacity development programs organized for tax administrators and officers at the federal and state levels, such as Federal Inland Revenue Service, FIRS, State Internal Revenue Service, including Lagos State Internal Revenue Service, LRS, to mention just a few. Judicial officers and legal officers of revenue agencies, legal departments of government institutions. His expertise has been deployed to servicing domestic and multinational companies across the continent. He has handled many tax litigations for tax authorities across Nigeria, corporates and individual taxpayers at the Tax Appeal Tribunal, State High Courts, Court of Appeal, and Supreme Court of Nigeria. Mr. Bashir has facilitated the Indirect Taxation Administration and Management course at the CITN Tax Academy, CITN Conversion Training for the ACCA, all between 2021 to 2024. He is currently a co-facilitator handling international taxation at the School of Postgraduate Studies, Faculty of Management Science, Accounting Department of the University of Lagos, Akoka. He's also an adjunct lecturer at the University of Ilorin and a doctoral researcher at the University of Ibadan. Mr. Bashir's dedication to legal scholarship is evident through his insightful contributions to the taxation field in the last 2 decades. He has authored chapters in tax-related textbooks, including Indirect Taxes in Nigeria, 2014, Value-Added Tax in Nigeria, Policy, Legal, Administrative Issues, and Options for Reforms, 2021. He has published several articles on taxation in both local and online international journals, newsprints, and media, including Monda, Guardian newspaper, The Nation, The Telegraph, amongst others. Ladies and gentlemen, before I welcome our facilitator, I believe his citation says a lot about the wealth of knowledge and experience we're about to glean from our facilitator. So please join me to make welcome Mr. Bashir Ramon. Thank you.
Good afternoon. Platform, colleagues, and my learned friends. I'm happy to be here for the second segment of tax webinar 3 for today. And in doing this, I would like to share my slides. Specifically, the topic is an overview of stamp duties under the new tax regime in Nigeria.
We should just have to see if the slide is we should see cooking the soup. Should I have it? Stop.
So sorry for the break in transmission. I believe everybody can actually see my slide. Yes, the topic is an overview of stamp duties under the new tax regime in Nigeria. And the content of this slide as follows. We have to consider the concept of stamp duties and historical development in Nigeria. We'll also be looking at dutiable instruments under the Act, stamp duties administrations as currently represents under the new tax law. We'll also be looking at the various forms of stamp duties as prescribed by the law. We'll also look at how documents can be stamped, the time within which to stamp them, and also the consequence of non-compliance for stamping. We'll also look at exempted instruments. As we all know, for every law, there will always be an exemption. So we'll also look at the right to object, especially in cases where you have grievances relating to the assessment and the procedure for filing such an objection or an appeal. We'll also look at persons liable to pay the stamp duties in respect of each of the species of dutiable instruments. We'll also consider offenses and penalties provided by the law. And in conclusion, we'll also be looking at the recommendation after reviewing the entire new tax legislation. To start with, stamp duties is one of the oldest taxes in the entire world. Historically, stamp duties actually originated from England, specifically in 1694. That was when France and England was at war. At that time, France had an allies with the Native Americans just to launch an attack on the fairy lands, which was within the jurisdiction of King William III. And at that time, England was considering how to finance the war, and then they decided to impose stamp duties, especially on the land documentation, because at that time, the bourgeoisies, those are the people that own land. And so the only way for them to generate revenue is to impose stamp duties. And of course, how did it come to Nigeria? We all know that Nigeria had a colonial history with the British government dated back 1890s. And at that time, they were also looking at how to finance the government in Nigeria. So they introduced the stamp duties by way of Ordinance number 41 of 1939. And that was the first time stamp duties was introduced in Nigeria formally. And then this particular legislation has also experienced several amendments. For instance, in 1942, 1946, 1950, 53, 54, 1955, 1956, up till 1990, when we now had the Stamp Duties Act 1990 LFN. And as a matter of fact, in 2004, the law was reorganized and recodified into our LFN 2004. Since 2004, there was no amendment. And that law still retained the old provisions of the 1956, whereby you have penalties of 2 kobo, penalties of 5 kobo, penalties of 1 naira. And so, in 2019, National Assembly decided to amend the Stamp Duties Act by reviewing the obsolete provisions. And also, in 2020 and 2021, respectively, the Finance Act also amended the Stamp Duties Act. Principally, one of the items that was reviewed was the dutiable instrument. In 2019, electronic money transfer was also included as one of the dutiable instruments. And so, today, by virtue of the Nigerian Tax Administration Act and the Nigerian Tax Act 2025, that Stamp Duties Act 2004 stands repealed and reenacted into the Nigerian Tax Act 2025. Specifically, in Chapter 8 of the new law, you find sections 124 to 143 of the NTA 2025 relate to stamp duties principal. Sorry, Chapter 5, sections 124 to 143 of that NTA 2025. Now, talking about dutiable instruments, as we all know from the history, the British government started imposing stamp duties on land instruments. But as time went on, they started increasing it into probate of will, marriage certificate, and some other legal instruments. But here in Nigeria, and as it stands under the NTA 2005, we have several dutiable instruments. Particularly when you look at Schedule 9 to that act, there are 48 instruments listed on that. But majorly, they are classified into the following. You have the mortgages, that is mortgage agreement, you have bill of sale, you have declarations of notarial act, you also have conveyances, sales, leases, tenancies, deposit receipts, contract of all sorts, the guarantorship, the appraisers, especially where you have a valuation of reports, valuation of assets, you have somebody to appraise or to assess that particular property, you have appraisers. Then we also have loan capital agreements, then shares, securities, bonds, otherwise known as marketable instruments. We also have trust, insurance policies, and finally, electronic bank deposit or transfer on accounts. These are dutiable instruments under the new tax law. I must mention that this has always been, even under the old law. Now, the question is, who administers stamp duties in Nigeria? There had been a lot of battles regarding administration of stamp duties, but principally under the old law, the law was extremely clear under Section 4, Subsection 1A and B of the Stamp Duties Act 2004 as amended then, the law provides that where legal instrument is executed between companies and companies or between companies and individuals, the appropriate authority to collect and administer is federal government. And pursuant to Finance Act 2021, it amended the word federal government to Federal Inland Revenue Service, which is now NRS. And still under that same law, the subparagraph B of it, it provides that where documents are executed between individuals or individuals and business names, then it must be collected and or administered by state government. By the same Finance Act 2020, the law was amended to substitute the word state government to relevant state internal revenue service. That was the position. Not until when the dispute arose as to who collects relevant stamp duties on electronic money transfer. At that time, state government began to review their position, review their authorities under the Stamp Duties Act, and they discovered that there are different transactions between people and between companies. Company can transfer money to an individual can transfer money to a company. And so individual customers of the banks too can also transfer money to each other. So they decided to single out transfer of money between individuals. And they decided to call on the banks to send relevant reports and relevant returns for stamp duties on electronic money transfer between individuals. Of course, there were a lot of objections from the banks saying that no, yes, we have collected stamp duties, but these stamp duties have been remitted to the FRS. We don't have any other authority to, or any other obligations to disclose or to even remit anything to the state government. This was fought. I remember the case of, that is the case of GT Bank against Abia State Internal Revenue Service. There's also another case, the case of Anambra State Internal Revenue Service and another bank there. And that is, yes, it's GT Bank against GT Bank PLC against Anambra State IRS. Then there's also another case of Unity Bank PLC against Abia State Internal Revenue Service. There's also another case of Standard Chartered Bank PLC against Cashman International Services Limited. What are all these cases saying? All these cases are saying that, number one, for Standard Chartered case, this was a case where NIPOST, that is Nigeria Postal Service, decided to appoint an agent of collection. They appointed Cashman International Services Limited to collect stamp duties from the banks, that is in respect of electronic money transfer. And of course, some of the banks said, no, we cannot give you the money. The money has already been given to the relevant Federal Inland Revenue Service. Of course, the Cashman Services International Limited went to court on behalf of NIPOST. And when the matter was filed in court, of course, I think there are about 21 commercial banks in that matter. And they filed an objection to the case that the case is incompetent. They do not, the Cashman Services Nigeria Limited does not even have the local standard to file the case. The objections was dismissed, and there was a further appeal to the Court of Appeal. At the Court of Appeal reviewed the provisions of the Stamp Duties Act at that time and discovered that in Section 114 of that law, to the effect that it is only the Attorney General of the state or Attorney General of the Federation, depending on the taxes you are talking about, can only seek recovery. And so the court held that Cashman's Limited or even its principal, which is NIPOST, does not have power to collect stamp duties. Also, in the case of Anambra GT Bank against Anambra Internal Revenue Service, this was also in relation to electronic money transfer. Of course, when the matter was filed in court, the High Court of Anambra State considered the fact of the case and decided that the transactions between individuals can only be collected by state government. And that the mere fact that the bank platform is used does not make the bank as a party to that transaction. That case, there's no appeal as we speak. Again, the case of Unity Bank against Abia State Internal Revenue Service was filed at the Tax Appeal Tribunal. where the tax appeal tribunal considered the earlier decision in Standard Chartered Bank and Kashmir, as well as the GT Bank PLC against Abia State Internal Revenue Service, and came to the conclusion that looking at the position of the law as at that time, that deposit receipt or arising from transaction from banks were clearly exempted at that time. That was the position. Now, all these cases were going on, not until the National Assembly came to the rescue by legislating the provision of Section 89A, subsection 4 of the Stamp Duties Act through Finance Act, by stating that where it comes to the case of electronic money transfer duty or levy, the FRS, now NRS, should collect and share the proceeds to all the state of the federation on the principle of derivative principle. That was the position before 2025 came in. Now that Section 196 of the NTA 2025 has repealed that Stamp Duties Act, all those controversies, all those provisions of the Finance Act 2019, 2020, 2021 have also stand repealed. The question now is, what is the position? The law, as we speak, is silent about who collects or who has authority to collect duty on electronic money transfer. But I must say that looking at the provision of Section 3, subsection 1A of the Nigerian Tax Administration Act, it provides to the effect that the NRS shall have exclusive jurisdiction or exclusive competence to collect stamp duties and some other taxes. Then when it gets to subsection 3(1)(b), it also provides that NRS shall also have competence to administer other taxes. It includes income tax, it also includes stamp duties. There was no mention as to whether a particular instrument will be collected by so person or another person. But reading through the provision of Section 87, subsection 1 of NTAA 2025, it also listed the fact that the provision that the state government shall have power to administer and collect income tax, payee, as well as stamp duties. What that means is that both federal government through NRS and state government through the relevant state internal revenue services will both have powers to collect stamp duties. But the question remains whether the state will have power to collect stamp duties in relation to electronic money transfer remains unresolved. That means we are back to status quo. So that's the business for we lawyers to take up. Now, there are various forms of stamp duties as provided under the old law and even the new law. Under the old law, there are just two forms. You have the fixed rate, you also have the ad valorem rate. When we say fixed rate, it simply means a duty that is fixed, a flat rate that has no correlation with the consideration of the value of the document you are about to stamp. It is fixed. For instance, we all have electronic money transfer. If you like, transfer 10,000 naira and above. If you like, transfer 1 million naira. If you like, transfer 50 million. So long as it is flat rate, you pay the same rate, 50 naira, irrespective of the amount you are transferring. It's fixed rate. That is what we call flat rate. The second type of rate or duty under the Act, both old law and the current law, is called ad valorem rate. Ad valorem is just a Latin maxim which simply means for value or for consideration. Here, when an instrument is to be assessed for stamp duties, the relevant tax authority will now consider the value of that document. Value in the sense that, for instance, when you talk about deed of assignment, you are transferring a property from Mr. A to Mr. B. There is consideration. That is the purchase price. So the law is talking about the consideration of that particular contract. How much is the property sold for? 5 million, 10 million, 50 million. The law will take into cognizance of that particular consideration. That's why it is called ad valorem. So a certain rate or certain percentage of the consideration will be charged as a duty. Now, these are examples of flat rated stamp duties. You have payment receipt, I've mentioned that. You have bank check per leaflet, guarantors form. We have appointment of trustees or of attorney. We have bill of lading. We have electronic money transfer, which everybody knows. We also have bill of exchange payable on demand. So all of this, you can see the rate, 50 naira, 100 naira, 500 naira, 1,000 naira. These are the rates. You find the rates applicable specifically on Schedule 9 of NTA 2025. Again, under Section 124 of the NTA, we see that the ad valorem rate is also provided. And examples of documents that are chargeable to ad valorem rates are as follows. You have tenancies, you have lease, you have conveyance, you have contractual agreement, you have mortgage and debenture loan, we have property valuation, life insurance policies, you have bill of sale. For instance, let me take tenancy as an example, or lease, where you're under the old law, which was brought by way of an amendment through Finance Act, the position was that where your tenancy or your leases is between 1 year to 7 years, you pay 0.78%. But where your lease or tenancy is above 7 years, but not more than 21 years, you pay 3%. And where your lease or tenancy is above 21 years, you pay 6%. But now that law has been amended by this new law, and it provides that where there are two classifications, where your leases or tenancy is from 1 year to 7 years, you pay 0.78%. But where it is 7 years and above, then you pay 3%. And I think that's a good provision because it has reduced the tax liability from 6%, the maximum of 6% to 3%. Then for insurance policy, it is 0.075% of the value of your policy. Now, your document has been executed. You have entered into the agreement, parties have signed. What is the time limit within which to present that document for stamping? I must mention that in the tax authority's office, there is usually one office called Office of Commissioner for Stamp Duties. In some other states, they call it Director of Stamp Duties. But I'm aware for the NRS, it's usually Commissioner for Stamp Duties. And I think in Lagos State too, they also use Commissioner for Stamp Duties also. So ordinarily, in all the tax authorities' office, they are supposed to be a unit dedicated to stamp duties, or an officer that dedicated for that. So when you execute your document, the law provides, under the old law, classified documents into two: documents that were executed in Nigeria and documents that were executed elsewhere, that is outside Nigeria. And for documents executed in Nigeria, it provided 40 days from the date of execution. You must stamp your documents. And for documents executed elsewhere, that is outside Nigeria, it provided 30 days from the date of entry into Nigeria. That was the position. But that position has now changed under the new dispensation. The law now provides that the law actually recognizes documents that have been executed in Nigeria or outside Nigeria, but it only provides for 30 days, irrespective of where the document has been executed or is coming from. Or maybe this is an omission, I don't know, or maybe that could also be the reform that the drafter of the law has sought to achieve. So now, in stamping the document, there are so many ways such a document can be stamped. Number one, you have to present your document for assessment. When you present it, they will assess it, they look at it. Is it a fixed rate? Is it an ad valorem rate? If it is a fixed rate, they will assess it, put relevant assessment on it. And if it is ad valorem, they will also do the assessment. Upon the assessment, you will be asked to go and pay. After payment, you come back and show the relevant evidence of payment. And they will now do any of the following. It's either they use a die. A die is just a seal, like something like a common seal. They will impress it on that document as an evidence that you have stamped the document, or it can be an electronic receipt. It may also be an electronic digital tagging or issuance of a certificate. You'll be given a certificate. So it depends on the form which a specific relevant authority will want to take. It may also be a tax stamp, and this is where the NIPOST came in sometimes in the past, because in those days, the NIPOST, they sell a postage stamp for delivery of, for courier of documents and other consignments. So in those days, people will go to a post office, they buy postage stamp, they affix it on the receipt and all of that. But the law is now saying that there is a distinction between postage stamp and tax stamp. So, however, this particular way of denoting stamp duty on an instrument is not limited to what has been identified under the law, because Section 3 of that Section 123 of the NTAA provides to the effect that the Joint Revenue Board of Nigeria, in collaboration with NIPOST, may design another form or another way of denoting stamp duty. Somehow, the NIPOST has found its way or itself in the administration of stamp duty. Now, what is the effect of non-compliance? You have a registrable instrument which has been executed by parties, and you have been unable to stamp it. What is the legal effect? Under the old law, specifically under Section 21, subsection 1 and 4 of Stamp Duties Act 2004, as amended, then the law provides that where you are to tender that document, which you have failed to pay your relevant stamp duty upon, that document will not be admitted as evidence in civil cases. But if it is criminal case, the rule about inadmissibility will not apply. However, in that particular same section, the law considered the fact that the whole essence of non-compliance provision is to ensure that the government generates its revenue from stamp duties. And so there's a leeway provided under the law to the effect that where a party tendering the document who has failed to pay but has now offered to pay the unpaid duty, then he will be allowed to pay together with the relevant penalties and then come back to tender his a document in evidence, and it will be admitted. That used to be the position. For instance, in the case of Okuwobi against Ishola, this matter was in relation to land matters where somebody sold the land and they wanted to prove that he bought the land from another person, and he tendered the land receipt, the receipt of payment which he was given. Upon tendering the document, the other party raised an objection to the effect that no, this document ought to have been stamped, but you failed to pay the relevant stamp duties, and to that effect, that document is inadmissible. The chief magistrate sustained the objection, and they fought the matter up to the Supreme Court. In getting to the Supreme Court take a different view to say that looking at the provision of Section 22, subsection 1 of the law, it provides, subsection 2 of the law, it provides to the effect that there is a leeway through which a defaulting party can come back to pay together with the default fees. Unfortunately, this provision had been taken away from the new tax regime. So the current position, now as we speak, under Section 127, subsection 1 of NTA 2025, is to the effect that where you fail to stamp a document that is dutiable, your document will not be admitted in evidence. But if your case is a criminal one, the rule about admissibility will not apply. That is the position. But of course, I am of the view that when a reform is to be made to a law, especially taxing statute of this nature, the whole essence of it is to recover the revenue of the government. I think that the removal was wrongly done, in my view. That being said, I feel that there is need for reform of that particular provision in the future. Now, what are the exempted instruments? As we all know, like I said earlier, that for every law, there must be an exemption. So there are some documents that have been exempted from stamp duties. I must mention here that there are some other laws that are related to stamp duties or which affect stamp duties, but which is not part of the Nigerian Tax Act or Nigerian Tax Administration Act. And I will mention two of them. For instance, Section 680, subsection 1 of CAMA 2020 provides to the effect that where there is a document, contract, charges, and other relevant transactions of a company in liquidation, this particular document is exempted from stamp duty. That is one of the exemptions. 2, all instruments, documents on which duty is payable by consular officers or ambassadors arising out of its official duty. This document, by virtue of Section 9 and Section 17 of Diplomatic Immunities and Privileges Act, those documents are also exempted from stamp duties. Now, for the NTA 2025 provisions, you have money paid into or transferred electronically between accounts of the same person in the same bank. And this is the real gist. I am having an account with a particular bank in Nigeria, and I'm having current account and savings account. There is possibility for me to be moving from my current account to my savings account and vice versa. What this exemption is saying is that such transfer, even if it is above the threshold of 10,000 naira and above, then I should not be charged stamp duties. I just want to advise that everybody should watch that when you are transferring from your account in the same bank. Then when you have mortgage values less than 10 million naira, before now, once it's a mortgage transaction, irrespective of the value, you are expected to stamp duty the document, that agreement. But now, where your mortgage transaction is 10 million or less, then it is exempted. You also have a property sale less than 10 million naira. This is also exempted. Then where you have receipts given by any person in regulated securities lending transaction, all these are exempted. Where you have shares, stocks, bond issued by government, either state government or federal government, it is also exempted. And lastly, on these, you also have property sale or property lease less than 1 million naira. This is where it concerns, I think, majority of people that are landowners, where you have property, you have you are letting out a room and parlor, 2-bedroom flat, or even a duplex. If your rent is less than 1 million naira, then your deed of lease or your tenancy agreement is exempted from stamp duties. That being said, where you now have a case of you have grievances, or you are dissatisfied with the assessment of the stamp duties given to you on your instrument, then the law says you have right to object. By virtue of section 41 subsection 1 to 6 of the NTAA, you have right to raise an objection. Where you fail to file the objection within the prescribed time, then that assessment will become final and conclusive. I recommend the provision of section 43 of NTAA 2025 for that position. Now, how do you now file your objection? Ordinarily, depending on your grounds of objection, this will now determine how you approach the relevant tax authority. For instance, if your objection is on the ground that the document is exempted, you don't need to pay anything. File your objection within 30 days from the date of the assessment. But where your objection is that, oh, it's an over assessment, then I always recommend to our client that please pay the appropriate assessment that you feel that it should be. Then you file your objection within 30 days from the date of assessment and that payment. Now, under the old law, the relevant tax authority has their time, specifically 7 days, within which to respond to your objection. And after which they decide. There are 3 decisions for that. They either refuse your objection, or they confirm it, or they even add more to it. Under the new law, the law provides that once you file your objection within 30 days, the relevant tax authority has 90 days within which to consider your objection. But if they fail to react to your objection, then the law now provides, this is a new provision, an innovation in this related to stamp duties and even almost all the taxes generally, where the relevant tax authority fails to react within 90 days, that your assessment becomes final. It means that the relevant tax authority is presumed to have agreed to your assessment. Now, where there is a disagreement or grievance or a dispute or a dissatisfaction to the decision of the relevant tax authority, you are also having the right to appeal to the Tax Appeal Tribunal. Tax Appeal Tribunal is established under the Joint Revenue Board of Nigeria under Section 29 of that Act. And Tax Appeal Tribunal will listen to both parties, decide one way or the other, either to reduce the assessment, confirm it, or even increase it, as the case may be. There is a danger looming. The danger that is looming is that the current law provides that you file an appeal to the TAT and they decide. But where there is a grievance or a dissatisfaction with the decision of the TAT, where do you go? Your guess is good as mine. You go to High Court, but the current law does not say so, and I will tell why. There have been 2 conflicting copies of the gazetted copy of this act. One provides under Section 41, subsection 1 to 9, to the effect that the decision of the TAT shall be appealed to the High Court. Depending on the relevant tax authority you are appearing before them, you can go to State High Court if the revenue is to the state. You can go to the Federal High Court if the revenue is for the federal government. And that subsequent appeal can also go from Federal High Court to Court of Appeal and to Supreme Court subsequently. Unfortunately, there's also another copy of the Gazette copy that deletes subsection 8 and 9 from it. And this is the relevant section that says the decision of the TAT can be appealed to the High Court and to Court of Appeal and Supreme Court respectively. So the question is, where do we go from here? Of course, law will never act in vacuum. By virtue of section 271 section 273 to 274 of the 1999 Constitution, we can see clearly that the Constitution has conferred original jurisdiction on the State High Court to deal with issues relating to revenue of the state. And also section 251 of 1999 Constitution also conferred exclusive jurisdiction on the Federal High Court to deal with revenue of the government of the Federation and the federal government. So the only way we can deal with the appeal arising from Tax Appeal Tribunal as we speak today is by going through the route of the relevant provision of the Constitution. And that being said, we now look at persons liable to pay relevant stamp duties. Under the old law, specific persons have been mentioned. But under the new law, the law is now clear, particularly under section 126 of section 2 of the Nigerian Tax Act. It provides to the effect that any person who is taking benefit, rights, or enjoying the services of the legal instrument to be stamped shall have the legal duty to pay. Of course, there is one exception there, and that exception is electronic money transfer. In such a case that it is only the transferor of the money that we pay electronic money transfer levy. So on the slide, as you can see, you have the bonds, you have the mortgages, you have a lease, you have appraisement, you have insurance policies. You will see that it is the person that is enjoying the benefit or to whom right is conferred will certainly have the legal burden to pay stamp duties. I must mention that there are some situations whereby complications can occur. For instance, where you have instruments that is executed in duplicates or in counterparts, how do you stamp duty it? You are having one copy, but you have several copies. The law provides under Section 142 of NTA 2025 to the fact that it is only one copy of that copies that will be stamped, and all others shall be certified as a true copy of the first one that has been charged, and you pay the relevant duty. Another situation can also occur where you have one instrument relating to more than one transactions of different subject matter. The way to go about it, the law provides that you will now have to stamp each of these transactions separately, and you pay the relevant duty. And another scenario that can also come up is also provided under Section 143 to the fact that where there are multiple instruments chargeable with ad valorem duty are executed for effecting the same transaction, how do you stamp duty such a document? The law provides that you will have to now take one of that instrument, you charge it for ad valorem on ad valorem basis, and then every other document that is relating to that same transaction to be charged at a fixed rate. See the provision of Section 140 to 142 of the NTA 2025. Let us now consider offenses under the law. There are several offenses there's even a general provision for offenses generally under the Nigerian Tax Administration Act. But those ones that are related to stamp duties, you find Section 113 that is in relation to fraud. Where you commit any fraud in relation to stamp duties is an offense. Failure to stamp dutiable instruments or documents is also an offense under Section 113 of the NTA. Then presentation of false declaration in any document to secure tax benefits is also an offense. And then obstruction from gaining access to information, books, or records in relation to stamp duties or even any tax at all is also an offense. And then non-compliance with anything in this particular act as it relates to stamp duties will also be an offense. All these offenses are contained in Section 113, 110, 119, and 127 of the Stamp Duties Act. I must mention that where an offense has been committed in relation to stamp duties by a corporation or group of individuals, then it is the partner, the director, or the trustees of that organization that will be held liable. Now, what are the penalties? The penalties are also stated in the relevant provisions that created the offenses. But generally speaking, where it is a case of non-payment, then the person will be asked to pay the actual duty that you have been assessed. Then you now pay additional 10% of the amount you're supposed to have paid. Then where there is also a case of late payment, then you have a penalty, an administrative penalty, which is also there. And if it is a case of any offense which is criminal in nature, then there is an administrative penalty of 1 million naira or an imprisonment not exceeding 3 years or even both. We also have administrative penalties of 10,000 naira for individual and 50,000 naira for company, especially for failure to keep record. Then finally, you have a refusal to supply information which attracts 200,000 naira and a 10,000 naira each for each day of default. How do we enforce, how does the relevant tax authority enforce stamp duties? This is contained under Section 57 and 58. Here, the law empowers the relevant tax authority to command any person to produce any documents or information or records, grant access for inspection of anything or building. They can also ask them to make copies of documents and deliver to the relevant tax authority. They can even compel your appearance before the relevant tax authority. And finally, the relevant tax authority may also remove any book, any record, any data or item from any office or building for the purpose of investigation for stamp duties. And under Section 61 of the NTAA, the relevant tax authority may also exercise its power of distraint where the stamp duty that you ought to have paid has become final and conclusive. And that will happen where you have been assessed, you have been given demand notices, you did not respond, you did not object, and the relevant time within which to object has lapsed. Then the assessed duty becomes final and conclusive. So for recovery, under the old law, the Attorney General of the state or of the federation, as the case may be, has the power to seek recovery. And under the new tax law, under Section 68 of NTAA, the relevant tax authority has power to seek recovery. However, where the case is criminal, then they also have the power to prosecute, but subject to the powers of the Attorney General of the Federation and Attorney General of the state, as the case may be. And the recovery must be done within the period of 6 years, after which the relevant tax authority will no longer have the power, except they can say that the assessment done 6 years ago has an element of fraud in it, but you have to prove with evidence. That being said, I also need to call our attention to the fact that under Section 60 subsection 1A of the NTAA, the relevant tax authority has the power to appoint an agent for a defaulting party, or to even assign the debt, the duty. And this is what is, and this is where everybody is shouting that a bank will just deduct my money. It's not just to deduct your money. Relevant steps must have been taken. For instance, in relation to stamp duties, the assessed duty must have been given to you. You must have been given the time within which to appeal. And if you fail to raise objection or appeal, and the relevant times of 30 days have lapsed, then they can assign that particular duty, because that duty becomes a debt owed to the government. And then they can assign to your bank. Don't forget, they have your details. They will just assign to your bank and ask your bank to pay. That is how it's likely to work, because it has not been tested. On the whole, stamp duties aspect of the Nigerian Tax Administration Act and Nigerian Tax Act of 2025 has come to stay. Principally, it has come to expand the list of exempted dutiable instruments and then focus on huge financial transactions and move away from small transactions. And that is good for taxpayers. That being said, as new as these particular laws is concerned, it is just being implemented. And we are just getting to see what will be the consequence, or what will be the aftermath, or the aftermath effect of the implementation of the law. But as we speak, there is already need for reforms in the following areas. One, there is need for clarity on which authority is responsible to collect the classes of duty provided, because under the old law, the clarity is clear, is there, but under the new law, it is not clear. Again, as I earlier mentioned, that under Section 41, subsection 1 to 7, the taxpayers has right to object. But when the decision of the TAT is made, where do you proceed to? It is not clear, because the current gazetted copy has not stated where taxpayers should go. So there is need for clarity on that. Third, there should be a provision to empower the judiciary for exercise of discretion in actualizing the purpose of revenue generating provision. Don't forget I mentioned the case of Okuwobi against Ishola. The Supreme Court interpreted the law in that manner because there is a clear provision that the court can actually direct a defaulting party to pay. But that such a provision is missing in the new law. And finally, there should be a way to develop ways or manners through which documents executed by individuals, companies, can actually be disclosed to the relevant designated agency for stamp duty purpose. And what am I saying here? You and I can execute land transactions. We can choose to keep it under our wardrobe. We can keep it on our shelves. We can keep it in a drawer. And nobody knows that document is executed. And so long as there is no litigation on that document, that particular document will not be subjected to stamp duty. On the final note, I'd like to say that the fear of new tax law is the beginning of tax compliance in Nigeria. The fear of the new tax law is the beginning of revenue generation for we lawyers, for tax attorneys, tax consultants, and the fear of the new tax law is also the genesis of increased internally generated revenue for the relevant tax authority. Thank you very much.
Stop sharing, stop sharing. Wow, thank you very much, Mr. Bashir Ramoni, for that beautiful and comprehensive dissection of stamp duties compliance obligations in the new tax regime in Nigeria. Someone on YouTube said, I love the historical background. Meanwhile, for many of our participants who are asking about the training session, the training recording and the training slides, please note that the current training is being streamed live on YouTube. And after the training session, it will become an uploaded video, and that makes it accessible to the public. Without further ado, it's time for the Q&A session, and I'm sure our facilitators are ready. Firstly, we'll take questions on the first session, as a result of which Mr. Sam will come up to answer them. Thereafter, Mr. Bashir will come up to answer questions on the second session. Thank you.
Okay, thank you very much. Questions are welcome now.
Yes, sir. Mr. Sam, someone is asking, and I think this person is probably a former colleague of yours. There are two questions from the civil service. Someone says, are civil servants also mandated to file tax returns individually? Another person says, we that work in the government office, my office deducts our taxes and remit to the tax authority. Can we get TCC? So we'll be glad you can answer both questions together.
Okay, if you look at the provision of the Nigerian Tax Administration Act, which we have mentioned over time in the lectures, every taxable persons are liable to file tax returns. So whether you see the law specifically provides for MDAs, ministry departments and agencies of government, they must file. And then I remember when I was with the LIRS, ministries like Ministry of Justice that were closer to us that we work together will come, because they would have told them in all the ministries, if you don't file your tax return, your salaries will not be paid. So as individual employees, then they were filing. Some of them will have to come to the office, meet the IT, or meet some of us, and we assist them with the filing, including directors, including most of those ministries will come, and because it is very essential for them to come. Otherwise, is it that a particular amount of their salary will be deducted? Even while in LRS, then you'll be told that if you don't file, you will not pay. Your salaries and amount might be deducted, or you will not be paid. And so people will be compelled to pay. So on the other issue, whether your employer has filed or not, under the old law, yes, once your employer file, you may demand for TCC, but you must have paid your taxes promptly for a minimum of 3 consecutive years before you can apply. So under the new law, it is compulsory for all employees, whether you are in government or not, to file personally, aside from your employer's filing, whether or not it is a new income.
Thank you very much, sir. Another question says, is someone who is below 17 years of age taxable, even when he does a small-scale business in Nigeria?
Well, as defined, I've defined according to Section 147 of the Nigerian Tax Administration Act, anybody who does any economic activities or other tangible and intangible properties for the purpose of generating income, particularly when you now have a business, you are liable to pay tax. You might say, yes, you have not attained the age of 18, but you are making income. Even there are properties inherited. So taxes will be levied either on the trustees or on the executors of such property on behalf of that beneficiary. So they are liable to pay taxes as long as you earn income.
Okay, sir. So I think maybe this is from a sole practitioner or legal practitioner in general. He said, does the new law allow for monthly filing of income tax, particularly by a law firm?
Yes, the law allows for both monthly and annual income. So under the old law, you see that there are payee regulations which mandates that, okay, you should file. And there are monthly ones, there are regulations that will come even with this new law that will guide you on how to do it. So it is the monthly one that transforms into the annual returns at the end of the year. But the annual is specifically compulsory for owners of firms and employers.
All right,
that
sir.
is the most important and compulsory one.
All right, sir. Thank you very much, sir. This question is quite critical. Someone says, please, what if the company is just registered, but it's not carrying on business? Will you still be required to file tax return? Or when you start business, you start filing?
Well, under the old law, some when we prosecute them, some will come. And so when we look at the time they apply to the relevant tax authority or the nearest tax station for registration, we'll look at the date of registration. If it predates that time or it comes after, then it will determine whether we'll penalize them for failure to file within the stipulated time. But under this new law, it is very compulsory. You have seen it there, Section 13 and Section 14 of the Nigerian Tax Administration Act has said it, whether or not it is a nil or negative income. From the moment you file, if it is a business name or an individual, you must file. Don't wait and be saying, I'm looking for way out. It might be very, very dangerous. It doesn't cost you anything, even if it is a negative return, even if it is nil, file. But for companies, the law has said it, that if it's a newly incorporated company, limited liability company, within 18 months from incorporation, or not more than 6 months after the incorporation of the company, Section 11 of the Nigerian Tax Administration Act.
All right, sir. Thank you very much, sir. Someone asked a critical question saying, now that employees have to file separate tax returns, what happens when a person moves between two different companies within a year?
So employees' return has nothing to do with your employer. While you are with one employer, your employer files, and it's an annual thing. It's usually for the preceding year. For instance, when in 2026, you are only filing for 2025. So even if in 2025 you move between 2 or 3 companies, it is the income that accrues to you as an employee, as an individual employee, that you are liable to file. So all you need to do is keep records of this, and when it's appropriate time, file it. It is not your tax. It is just a statement of the necessary transactions or other operations that took place for you in that year, just for the tax authority to be able to reckon and reconcile with their own records.
All right, sir. Second to the last question is, please, what is the difference between attested statement and audited statement?
So attested statement, like I mentioned earlier on, is done by either the auditor or the accountant who prepares your audited financial statements. And I think that is supported by Section 405 of the Company and Allied Matters Act 2020. It mandates them to certify to the accuracy of the information provided in that audited financial statement. Why the audited statement is the audited financial statement, otherwise known as audited account, prepared by an expert auditor or accountant, and reflects the transaction of the company starting from the gross turnover to sales, cost of sales, and other transaction, capital, and other allowances that will be allowable by law, and that will be deducted and then to arrive at profits before and after tax.
All right, thank you, sir. The final question, I think this person is speaking for the bulk of the Nigerian population. Says if a small company as defined under the NTAA 2025 is exempted from filing annual tax returns, are there also individuals and self-employed persons who are exempted from filing annual tax returns?
Don't get me wrong. What I said there, I'm referring to Section 22 of the Nigerian Tax Administration Act, which borders on value-added tax returns. I've not said a company is exempted from filing returns. I said small companies or small businesses, they are exempted from filing VAT returns. So no individual is exempted. All individuals are liable to file, and so also for companies. So it only depends on the nature of returns that you are filing. There are some the individual will have to file. There are some the companies will also have to file, whether small or not.
Thank you very much, Mr. Sam. That will be all for now. We really appreciate your time. Thank you very much, sir. Now we'll take questions on the second session to be answered by Mr. Bashir Ramoni. Thank you, sir. Mr. Bashir, thank you very much, sir, once again. There are a couple questions here for you. First question says, a number of questions have the same purpose. One is saying, does it mean that where stamp duty is not paid on a dutiable instrument within the stipulated time, there is no room for regularization?
Okay. Now, where a duty is to be paid on an instrument and you have failed to pay or presented the document for stamping, two things are involved. If you are presenting it, that will be late presentation for stamp duty. So you will be penalized by an administrative penalties imposed by law. That's number one. But where you now decide not to even stamp at all, one, it constitutes an offense. Two, if you not present such a document before the court for civil matter, such a document will be inadmissible in evidence.
Thank you very much, sir. Somebody is asking regarding EMTL. Okay. Does this mean monies transferred between a person's accounts in different banks are taxable?
Yes. Now, the explanation I gave in the course of presentation is that what is exempted by law is that where a person, a customer of a bank, is operating multiple accounts in that same bank and is moving money from one of its accounts to another account in that same bank, that is what is exempted. It's just a case of you moving money from your left hand pocket to the right hand pocket of the same person. But where you are now having different bank accounts in another bank, that is not exempted. You have to pay.
Wow, thank you very much, sir. Another question says, I think this one touches most of Nigerian population. It says, who bears the cost of an ad valorem stamp duty payment? For example, for a tenancy or conveyancing document, is it the landlord or tenant, the buyer or seller for a conveyance document? Okay.
Now, in the course of the presentation, I think I remember citing the provision of section 126 of section 2 of the NTAA, of the NTA, which provides to the effect that it is the person taking the benefits, the right, or enjoying the services that has the obligation to pay. Now, let us narrow it down to the examples, leases. It is the person taking up the lease, which is the lessee. For instance, you have your landlord you have the tenant. It is the tenant that is taking a right of possession of that property. So it is the tenant that has the obligation to pay. And if it is buyer and seller, it's the seller that is taking ownership of that commodity or that item. So it's the buyer that's supposed to pay by law.
All right, thank you.
Although there is this case of Afolabi against Total Oil Nigeria PLC, where something like that happened. And of course, that Mr. Afolabi and Total Nigeria PLC had an agreement that whatever tax payable in respect of that transaction shall be paid by the person taking up the interest. And of course, the matter went up to Court of Appeal, and the court held that no, it is the person to whom the liability is shall have the duty to pay. I think the NTA and NTAA 2025 has come to shown more clarity as to who has the responsibility or liability to pay. It cannot be shifted.
Thank you, sir. The last question says, I think some people are already convicted and they are ready to pay stamp duties. So they are saying, please, how do I pay stamp duties on a deed of assignment? Do I take the deed to FRS or the land agency?
Well, the details of that fact is not stated here, but this is what I can say. Depending on the parties to that transaction, if the transaction is between company and company or company and individual, you go to the office of FRS. But if the transaction is between individuals, you go to the relevant state tax authority. And if you are in doubt, my services are open.
Thank you very much, sir. That will be all. Thank you so much.
Thank you
grateful
very much
for your
having
time.
me. I'm grateful.
It's been a pleasant 2 hours plus of learning, 2 hours of learning, and we are so much grateful for your time. We have come to the end of this training session. Please note that the link has been dropped. The link to get your CPD points has been dropped in the chat box on Zoom and the comment section on YouTube. This is an opportunity to say thank you to MBA, ICLE, and Simmons Cooper Partners for putting this wonderful training together. We also say thank you to our facilitators for their precious time and dispensing from their wealth of knowledge to us freely. Thank you once again, Learned 6, senior colleagues, and other learned colleagues in the meeting. And we say thank you for your time. I am Oluwadolapo Owoyokun once again, and it's been a great pleasure moderating this session with you guys, for you guys. Bye, and thank you, everyone.